Let's get right to the main question that people have. How far, how fast? You've said you're on board with a couple 50 basis point moves, but do you rule out 75?
Well, we don't rule out 75 forever, right? I mean, what I'm going to do is I think 50, the cadence we're going now seems about right to me. We're going to have to assess whether inflation is actually moving down, and then we'll be able to get more information after we do a couple of those to see. Both supply and demand are going to be moving over time. So, you know, the aim is we need to use our tools to do what we can to get demand in better alignment with that constrained supply. And so I don't want to rule anything out. When we get to that point in the second half of the year, we may have to, if we don't have inflation moving down, we may have to speed up. But if we see inflation moving down and demand moving down more than, you know, we might be predicting, then we can adjust at that point. But I do think that we need to be very committed to being resolute in doing what we can with our tools to get inflation down. And that's both the balance sheet, which, you know, we've announced that'll start in June, and also with the policy rate.
Well, your colleague John Williams said today he expects unemployment to rise because that's what you do when you raise interest rates. Are you on board with that? Would you warn people, yes, unemployment's going to rise, the economy's going to slow because we need to do that?
Look, we have excess demand in both product markets and in labor markets. So we can raise the interest rate or policy rate and slow that excess demand. But, you know, this is not going to be smooth. There's going to be bumps, and the unemployment rate may have to rise. We may get another quarter of or two of negative growth, but that has to happen in order to get inflation down. So we are tightening financial conditions, and we've got to continue doing that until we see inflation moving back down to our 2% goal.
Well, you get 2 quarters of negative growth, and that's the R word that Fed officials don't like to use.
Yeah. Well, I guess that's a rule of thumb, but it really is going to be like how much is demand slowing? You know, if you look at what happened in the first quarter, there was a negative read on GDP, but if you look at what's happening in the consumer spending side of that report and on the business side of that report, those were quite strong. There's a lot of demand momentum in that report. Yes, government spending went down. Trade, of course, was a big negative for growth in the first quarter, and also that inventory, you know, which had surged in the fourth quarter. There was still a high level of inventory investment, just not as high as in the fourth quarter. So again, I think it's always good to look under the hood of those reports, and we may see some of that happening over time. But again, you know, our goal is to bring inflation under control, have it start moving down towards 2%, and sustain healthy labor markets. I don't really see this as a trade-off right now. You know, in order to make sure that labor markets are sustainably healthy and that we can sustain getting to maximum employment, we need to get inflation under control.
Do you think that you would describe it as whatever it takes, your mission now?
I'm very focused on the inflation side of the equation because the labor markets are incredibly strong and demand on the product side is so incredibly strong. So there's no trade-off here. We've got to do what we can do with our tools to get inflation down, knowing that there are other factors that are affecting those inflation numbers too. And you know, the supply constraints are real, the disruptions. I talk to firms all the time, and they tell me in the district, you know, we thought those would be over sooner. Now they're lingering, and there's rolling supply constraints. They've been pretty resilient in figuring out ways to continue adding employees and adding product, but nonetheless, they're struggling. And the high inflation readings are not helping, and we need to do what we can do to get that down.
How far above neutral do you think you have to go? What would be your terminal rate?
Well, I think we're going to have to see how the economy responds to the rises in interest rates and the other factors that are going to affect both demand and supply going forward. Given where inflation is right now, I suspect we're going to have to move above neutral. But I can't tell you exactly how far above neutral, and everybody's neutral definition is going to be different. We've got to see how the economy plays out in the second half of this year and into next year to be able to answer that question. But we're going to be monitoring, you know, how fast is demand coming down, how fast are supply constraints easing in order to get that demand and supply better into alignment and take off those price pressures.
Well, you've got COVID lockdowns in China again, and you've got the war in Ukraine. How confident are you, A, in your forecasts, and B, that you could achieve the Fed's goal of a soft landing?
Well, we're aiming for that, right? There are a lot of scenarios out there where things could play out worse than my forecast, and a lot of scenarios where things could turn out better. We can't rely on luck. We can't rely on, oh, supply constraints are going to ease and that'll get inflationary pressures down. We have to do what we can do with our tools. But, you know, there is good growth momentum in the economy. Demand is still, you know, strong. The unemployment rate is very, very low. People are coming back to the labor market, maybe not back to pre-pandemic levels, but still we've seen labor force participation going up. So there's a lot of good things still in the economy. But we've got to do what we can. And as we bring interest rates up and allow our balance sheet to run off, I think we're going to be able to get to a good place. So I'm optimistic that there are still some good scenarios out there, but we have to do it. And it won't be smooth. It'll be bumpy, and we'll have to accept those bumps on the road, but be resolute and aiming for getting this inflation down.
Well, if you get inflation down to where is acceptable, and then what happens? Have we changed inflation dynamics and an inflation regime?
Right. Well, we're aiming for our long-run goal of 2%. Now, if the question is, will it take some time to get down to that level? Yes, because we know that inflation can be persistent, and we have supply constraints that, even though everyone hoped that they would be easing, are not easing, and there's upward risk to inflation. So it will take some time. I don't expect we're going to get inflation down to 2% this year, or even by the end of next year. But we need to see those monthly numbers moving down in a convincing way. I'd have to see compelling evidence that that's happening before I would want to say that we can ease up on what we're doing with policy in terms of taking away accommodation and perhaps moving above the neutral position.
We're speaking with Loretta Mester, the Federal Reserve Bank of Cleveland president, here on Bloomberg Radio and Television. If inflation starts to come down, but not very quickly, and unemployment starts to rise, are you sort of stuck on the horns of a dilemma?
Well, you know, policymaking is always complicated and difficult, and everyone goes into those meetings looking at those exact kinds of questions. You know, at this point, inflation is just way too high. The longer it stays at levels this high, the more risk there is that inflation expectations, the longer run inflation expectations will move up, and that'll just make things much harder to control. And so, you know, I'm really laser focused now on that inflation picture and making sure that there's convincing evidence that it is on a trajectory to move down, and that demand and supply are better aligned. And so I think that's what we have to focus in on, rather than what's the terminal rate or, you know, what's the outcome. We've just got to get this inflation under control. And by that, I mean, I have to see evidence that it's really moving down.
Are CEOs in your district telling you that they see any signs of a wage price spiral, or that they are in a price spiral?
Yeah, so there's certainly been, all the CEOs that I talk to, they've been raising their prices, and they haven't seen pushback from their customers yet. They're concerned that they will eventually get to that point, but on the other hand, their wage bills are rising, you know, pretty strongly. They've been raising their wages over time because they really have a high demand for getting more workers in. So there's concern that, well, that can't last forever, but so far they've been able to pass on their higher costs, and not just wages, of course, it's higher costs of their inputs, you know, metals prices, commodity prices, and all the supply constraints that make it more costly for them to ship things. And so far they've been able to pass on. There is concern that at some point that will have to end. So they're fully on board with getting inflation under control.
The financial stability report the Fed put out warned of liquidity issues in commodity markets and even in treasury markets. 2018, the Fed had to stop raising rates because the markets reacted. We have seen market ructions over the last week or so. How bad does it have to be before you would step in again? Or are you telling them the Fed put's gone, you're on your own, guys? Well,
the volatility in the markets there's a lot of moving parts there. Trading has been working. The markets, financial markets are working, right? The prices are moving down in the equity markets, but the financial market plumbing is working. I do have, focus in on sort of some of those structural issues that we saw early in the pandemic in the Treasury market, which really were an eye-opener that, this underlying structure and resiliency of these markets really need to be improved. And so the president's working group and other regulators are looking at that and taking steps to make that better. The money market mutual funds, another place. So in terms of those underlying structures, that's where I think we need to focus. But part of what the Fed has to do here is raise those rates, and there will be volatility, and there will be bumps in the road. But that doesn't change our focus on our long-term goals of maximum employment and price stability.